The economy is unpredictable, but we can understand where it stands today and where it's most likely headed next. In this video, we will look at the right data to understand what economic indicators are telling us about the current situation. Before anything else, we need to build a baseline, a clear picture of where the economy stands today. We begin with the broadest measure of output, real GDP growth. We use real values adjusted for inflation, so we're not mistaking price increases for genuine growth. Real GDP growth has held close to 2.5% year-over-year for the past 2 years, though it has slowed slightly more recently. Note that GDP is released slowly. As of now, the latest official release is for Q2. And, moreover, it's revised often, functioning more as a lagging indicator. To make it useful, we will have to look beneath the headline. First, the consumer. Real consumer spending is holding steady, maintaining a growth rate of roughly 2.4%. The American consumer has remained resilient, and this strength suggests that households are still confident enough to keep spending. Contrast that with the industrial and business sector. While consumers continue to spend, business investments are slowing. Real private domestic investment has been significantly more volatile. After falling into negative territory in early 2023, it has struggled to regain momentum, essentially flattening near 0% twice as we move through 2025. But how can investment remain relatively low when everyone is talking about high AI investments? In fact, AI infrastructure spending is included in the data. We can see strong investment growth specifically in real private investment in information processing equipment. This means that without AI-related investment, total investment growth would be even weaker. So, will the consumer be able to keep spending, or will the shortfall in other types of investment eventually lead to an economic slowdown? If we look at unemployment rate, since the start of 2023, it has risen steadily, climbing from 3.5 to 4.4% today. This confirms that an economic slowdown has likely already begun. For a more forward look, we turn to labor indicators like average weekly hours and initial jobless claims. The data shows remarkable consistency. This trend suggests businesses are in a holding pattern. They are not seeing enough surging demand to ramp up overtime, but they are also not expecting the drop in demand that would force them to cut shifts. Finally, we can check the pulse of the future using housing and financial signals. Housing is flashing a warning. Building permits have trended downwards, falling to 1.3 million units, and housing starts have followed. This decline shows that high borrowing costs are shifting new construction, a classic precursor to a broader slowdown. Then there's the yield curve. It has recently uninverted and returned to positive territory. Historically, this uninversion is the defining warning bell that often rings just before a recession begins. Yet, look at credit spreads. They are incredibly narrow, at just 1%. This signals that investors are confident and not fearful of defaults. So, based on the data, the economy is currently in a state of a fragile divergence. We are witnessing a tug-of-war between a resilient consumer, supported by government spending, and a contracting physical economy, like classical manufacturing and housing. So why then is Wall Street betting on a boom while Main Street signals not? Financial markets are looking at the future productivity of AI, pricing in a revolution. But the physical economy has yet to feel the benefit. If the AI spending cycle slows, the mask comes off, and the underlying weaknesses will be revealed. For now, we're witnessing one of the largest capital injections into the tech sectors in history. But despite this tidal wave of investment, the profits are flowing into only a handful of infrastructure players, most visibly Nvidia, but also select cloud hyperscalers. This dynamic risks creating a familiar pattern. Massive overbuilding, similar to the fiber optic glut of 2001. But today's environment is somewhat different though. Fiber networks back then were used at 7% of capacity. AI infrastructure today is already running an 80% utilization, but high utilization alone doesn't guarantee sustainable returns. To justify the current pace of capital expenditure, the AI ecosystem would need to generate high annualized revenue, on the order of hundreds of billions of dollars. But we're nowhere close to that yet. AI software is growing rapidly, but revenues remain behind. OpenAI, for example, is projecting revenues of around $20 billion for 2025, with any potential move into the hundreds of billions likely not occurring until after 2030. Similarly, Alphabet reported $41 billion in the first 9 months of 2025. While that represents solid growth of 31% compared to the same period in 2024, the overall revenue level remains relatively low. That doesn't mean that technology is hype, far from it. 77% of legal professionals already use AI tools for document review. Small agencies and developers are achieving 10 times productivity gains with a generative AI. But productivity at the micro level hasn't yet translated into macro level acceleration. So why the delay? Goldman Sachs projects that AI won't visibly lift global GDP until 2027, not because the tech doesn't work, but because the prerequisites are slow. Data cleaning, workflow redesign, and organizational changes. Until these foundational layers are fixed, AI cannot scale across the enterprise. But such delays could unsettle financial markets if investors anticipate faster returns. And we may even see a market correction before the productivity gains emerge. However, it is crucial to be invested. When the productivity jump comes, it may be sudden. But patience and selectivity are essential. Focus on companies that can significantly boost output per employer or reduce headcount or overhead costs through automation. So identify companies capable of turning AI efficiency into actual profit. And stay cautious with firms that may be overexpanding into the AI build-out without a clear path to monetization. Beyond tech fundamentals, we must also look at the monetary environment. While maintaining some defensive reserve can be beneficial, we are entering a period of significant fiscal and monetary expansion. Liquidity could inflate asset prices even without strong growth. The recently passed Big Beautiful Bill Act is projected by the CBO to increase federal deficits by 3 to 4 trillion over 10 years. Adding persistent liquidity pressure. The Federal Reserve recently injected approximately 125 billion through short-term repo and money markets operations to stabilize funding markets. These are temporary actions, but they still ease financial conditions considerably. Thank you for watching. If you found this content interesting, consider liking the video. If you have suggestions, feel free to leave a comment. And if you want to stay informed, don't forget to subscribe.